Welcome to The Explainer. Today, we're taking a dense, kind of dry textbook chapter on financial management and flipping it into a high-stakes corporate playbook. We're going to break down the exact mechanisms that CEOs and CFOs use to grow their empires. Get ready to understand exactly how the biggest companies in the world move their money, manage their risks, and multiply their value. All right, let's jump straight in. Picture this. It's 2007, and Tata Steel acquires Chorus. The price tag? A cool $12 billion. I mean, $12 billion. Think about the sheer scale of that number. This wasn't just another routine corporate purchase. This was an absolute game changer that reshaped the global steel industry, and pulling it off required absolute mastery over corporate finance. Which really makes you wonder, right? How does a company actually afford a $12 billion mega deal? It's not like you just write a personal check for that, and you definitely don't just drain the corporate savings account. To execute the largest private sector transaction by an Indian company outside of India at the time, Tata had to expertly navigate the exact financial mechanics we're going to unpack today. They used a highly calculated, incredibly complex mix of debt, equity, and internal funds. To unpack exactly how they pulled this off, our playbook today covers 4 key areas: decoding financial management, the 3 big decisions, the debt versus equity trap, and finally, fixed versus working capital. Starting with number 1, decoding financial management, the ultimate goal. Before we talk about billion-dollar acquisitions, we have to grasp the absolute basics. What is financial management actually trying to achieve? The official definition is the optimal procurement and usage of finance to reduce costs, keep risk under control, and achieve effective deployment of funds. But let's translate that into plain English. The real insider secret of corporate finance is that it's essentially about finding the absolute cheapest money possible and then investing it where it makes the highest possible return. Sounds super simple, doesn't it? But the execution is incredibly complex. You have to make sure you always have enough funds when you need them so the business doesn't just stall out, but you also have to completely avoid having idle cash just sitting around doing nothing. Every single dollar needs to be put to work. And that leads us to the ultimate golden rule. The primary aim of financial management is to maximize shareholders' wealth. Literally every single decision, from buying a new office laptop to a $12 billion merger, is driven by this wealth maximization concept. Ultimately, this means increasing the price of the company's equity shares. If a new factory or a new product line doesn't ultimately add value and boost that share price, the financial manager shouldn't approve it. It really is that black and white. Let's move on to section 2. The 3 big decisions, a financial manager's trilemma. To actually hit that goal of maximizing wealth, companies have to constantly juggle 3 core choices: the investment decision, the financing decision, and the dividend decision. These are basically the 3 pillars of financial survival. First up is the investment decision. Simply put, where do we put our scarce resources? This is all about committing funds into different assets to earn the highest return possible. When we're talking about long-term assets, you'll hear this called capital budgeting in the finance world. Because resources, meaning your money, your time, your manpower, are always scarce, you have to choose your investments incredibly carefully. A capital budgeting decision, like building a brand new steel plant from scratch, is a huge undertaking. It blocks a massive amount of funds for years, and it's largely irreversible unless you're willing to take a massive, sometimes company-ending financial hit. So you absolutely have to get this right. Okay, so you've decided to invest and take the plunge. Now you face the second hurdle. Whose money are you going to use? This is the financing decision. You need to figure out the exact quantum of finance to raise from long-term sources. Are you bringing in new shareholders, or are you securing borrowed funds from a bank? It's a really delicate balancing act. You have to meticulously identify the available sources, compare their varying costs, and deeply weigh the risks of each option before you take a single dollar. And then there's the dividend decision. You made some money. Great. Now what do we do with the profits? This dictates how much of your hard-earned profit gets distributed back to the owners and how much is retained to fuel future growth. Put yourself in the CEO's shoes for a second. Do you reward the shareholders today with a cash dividend to keep them happy right now? Or do you keep that money locked safely inside the business to fund the next massive project that could double the company's size in 5 years? It's a constant, ongoing debate between immediate gratification and long-term expansion. Which brings us to section 3, the debt versus equity trap, mastering capital structure. Mastering capital structure is, without a doubt, the trickiest, most dangerous part of the financial playbook. Capital structure is just the mix between owners' funds, which is equity, and borrowed funds, which is debt. It's the exact recipe a company chooses when deciding whose money to use. And here is the secret sauce. Finding the optimal balance between these two forces is the absolute key to increasing a company's value. But here's where the trap comes in. You have this core tension. Debt has a cheaper cost, but it is highly, highly risky because of obligatory interest and repayment commitments. If you miss a payment, it can literally force you into liquidation. Equity, on the other hand, is considered far safer for the business because there are no obligatory fixed payments, but it costs significantly more in the long run. Why? Because lenders accept a lower return since their payment is legally guaranteed by a contract. Equity shareholders demand a much higher return because they're taking on all the risk. If the company goes under, they are at the very back of the line. And that right there defines financial risk. It's the chance that a firm will fail to meet its payment obligations. Because debt requires those obligatory, non-negotiable payments, taking on more debt automatically dials up your fixed financial charges, which directly dials up your financial risk. If you have a terrible year, a global recession hits, and your revenues just completely dry up, well, the bank doesn't care. They still want their interest payment. So with that terrifying risk hanging over a company's head, why would any sane financial manager ever borrow money instead of just using equity? Well, let's look at the math. Imagine a firm with a steady operating profit, or EBIT, of 4 lakh rupees. Let's trace their earnings per share, their EPS, across 3 different scenarios as they take on more debt. In situation I, they play it completely safe with 0 debt, and the EPS sits at 93 paise. But skip over to situation 3. By carrying 20 lakh in debt and paying a 10% interest rate, their EPS actually jumps up to 1 rupee 40 paise. By using cheaper borrowed money, the company mathematically magnifies the returns for the equity shareholders. It's a brilliant financial lever when you know how to use it. This neat little trick is called trading on equity, using fixed-cost debt to boost the earnings per share for equity holders. But it reveals a massive, potentially fatal catch. Adding debt only boosts your EPS if your return on investment is strictly higher than the cost of that debt. Let me explain what I mean. If your business is generating a 13% return on investment and your bank loan only costs 10%, you are capturing and keeping that 3% difference. It's fantastic. But if the economy turns and your return on investment drops below that 10% interest rate, this exact same mechanism will rapidly destroy your earnings per share. The lever swings violently the other way. It is the ultimate double-edged sword. All right, on to our final piece of the puzzle, Section 4, Fixed vs. Working Capital, the day-to-day reality. We've talked a lot about theory, so let's ground this back in reality. Every single business has to fund 2 completely different things. They have to fund their long-term future through fixed capital, and they have to fund their daily survival through working capital. Fixed capital is blocked in long-term assets that last more than a year. Thinking back to Tata Steel, this is the massive blast furnace they build. It's the infrastructure. Working capital, however, is what keeps the lights on right now. It's the short-term assets. It's the money used to pay the electric bill, pay the workers, and buy the raw iron ore every single week. When managing that working capital, financial managers face a relentless tug-of-war. I like to call it the ultimate balance, liquidity versus profitability. Keeping a ton of cash on hand provides fantastic liquidity to easily pay all your bills on time, but it gives you exceptionally low returns. So you have to constantly strike a delicate balance to stay profitable without overextending. Cash sitting safely in a corporate vault doesn't generate wealth for the shareholders, but running out of cash means the business shuts down immediately. So let's bring it all back to where we started. Tata Steel used over $8 billion of debt to help finance that Corus acquisition. They took on massive, calculated financial risk to maximize shareholder wealth by trading on equity. They played the game at the highest possible level. Knowing what you know now about the delicate teeter-totter of debt, equity, and risk, take a hard look at any business you interact with. The ultimate question for any financial manager stepping into this arena is this: are you structuring your capital to maximize wealth, or is your capital managing you?